as you all might be seeing on the screen that we are doing startup finance theory in this video. Okay, so let's start very quickly because I want to like finish it within 10 minutes so that it doesn't take up much time on the AFM exam day to revise it. Okay, so there are so many topics. Okay, this is I say has given a special weightage to this chapter. Okay, so let's finish it quickly. Okay, so some of the innovative ways to finance a startup. How can a startup get finance? Okay, first is personal financing, very easy term. Okay, okay, then personal credit lines. Okay, very easy term. Okay, then family friend is also very easy to understand. Okay, then the term there are like few terms that I have marked that from then if the MCQ comes, then a person may get confused if he or she hadn't studied in like deep. Okay, so first is peer-to-peer lending. Okay, in this a group of people come together and lend money to each other. Okay, so in like it is very clear, like, English is very clear, so I won't explain it here. Okay, peer-to-peer lending has been there for many years. Okay, many small and ethnic business groups having similar faith or interest generally support each other in their startup endeavors. Okay, so this is peer-to-peer lending, like group of people come together and like help each other. Okay, then next is crowdfunding. Crowdfunding is the use of small amounts of capital from a larger number of individuals to finance a new business initiative. Okay, and crowdfunding makes use of the easy accessibility of vast networks of people through social media and crowdfunding websites. Okay, you can even search Google for these websites. Okay, to bring investors and entrepreneurs together. Okay, next is microloans. Okay, microloans are small loans that are given by the individuals at lower interest rates to a new business ventures. These loans can be issued by a single individual or aggregated across a number of individuals, who each contribute a portion of the total amount. Okay, then there is vendor financing. Vendor financing is the form of financing in which a company lends money to one of its customers so that he can buy products from the company itself. Like the vendor is providing a finance to the customer itself. Okay, the customer is startup here. Okay, then vendor financing also takes place when many manufacturers and distributors are convinced to defer the payment until the goods are sold. Okay, this is like a, you can say, facility provided by the manufacturers or distributors. Okay, this means extending the payment term to longer period, that is 30 days, 45, 60 days. Okay, next is purchase order financing, easy term. Then factoring accounts receivable is also easy term. You do is like the startups can sell their debtors. Okay, once they sell something, then they're treated as trade receivables. Okay, so they sell them and get 80-90% amount on the like initial stage itself, or and when the like full amount is realized, then they get some portion of that. Okay, after deducting the interest charges that the factoring company will deduct. Okay, the next is pitch presentation. Pitch presentation is a short and brief presentation, not more than 20 minutes. Okay, it provides brief presentation using PPT to provide quick overview of business plan, convincing the investors to put some money into the business. So there are few steps. Introduction is very easy, brief account of yourself. Then is team, introduce about the audience, about the team, that who are the like behind the scenes team and who are the product development, stage development. Okay, then marketing development, who are the like all the persons behind the business idea. Then problem, further the promoter should be able to explain the problem. Then for instance, Facebook launched, it has some new features which made it stand out in comparison to the Orkut. And next is solution, problem, there is problems and there should also be a solution. Okay, then marketing, sales. Okay, then projections or milestones. Okay, easy. Okay, income statement, in the projections or milestones you have to give income statement, cash flow statement, balance sheet, like all the financial statement things. Okay, and then competition, you have to also show a slide for this. Okay, and how are you trying to counter that thing. Okay, then business model, what is your like, what are you trying to solve that. Okay, that is like problems, you can say the detail in the problem. Okay, this is business model. Okay, like how are you trying to solve your problem. Okay, this is a business model. And financing, how are you trying to raise the money. Okay, then concept of unicorn, it is startup is referred to as unicorn if it has following features. First is privately held startup, valuation of startup reaches USD 1 billion. Okay, and emphasis only on the rarity of success. Okay, and other common features are like new idea, disruptive innovation, consumer focus, high on the technology, etc. And however, this is important, like this can be asked in MCQ. It is important to note that in case the valuation of any startup slips below USD 1 billion, it can lose its unicorn status. Okay, hence the startup may be unicorn at one point of time but may not be at another point of time. It is very possible, like USD 1 billion you have to remember, and this thing. Okay, next is in September 11, this is also MCQ question. InMobi was the ad tech startup, first unicorn of India in 2011. InMobi, SoftBank invested USD 200 million in InMobi, and it became the first ad tech startup, first unicorn. Okay, then in 2018 Udan became the fastest growing startup by becoming a unicorn in just over 2 years time. Udan and InMobi you have to remember for the MCQ, or I have also marked few of the companies. You can read them, like these are the famous companies that we already know by the name. Okay, next is the next thing is this. Yeah, India has now emerged as the third largest ecosystem. Okay, and after for startups globally after US and China. Okay, with over 59,000 DPIIT recognized startups. Okay, as per the data, this is not worth of reading. Okay, because these figures have changed now. Okay, then next milestone for unicorn is to achieve its it is to become a decacorn, and that is a company which has attained a valuation of more than USD 10 billion. For unicorn it was 1 billion. Okay, and for decacorn it is USD 10 billion. And after a few years, like unicorn will be of no use and decacorn will be used terms. Okay, then next is the mode of financing. For this, first is bootstrapping, very easy. There are few types of bootstrapping, trade credit, and there's factoring that we already understood in the first topic. Okay, then factoring and leasing. Okay, so you can even read out them if the ICI asks any MCQ, then you may be able to figure out. Okay, then angel investors invest in small startups or entrepreneurs. Often angel investors are among an entrepreneurs family friends. Okay, the capital angel investors provide maybe one-time investment to help the business propel, or an ongoing injection of money to support and carry the company through its difficult early stages. Okay, then angel investors provide more favorable terms compared to other lenders. Okay, since they usually invest in the entrepreneur starting the business rather than the viability of the business. Okay, so like this try to provide a push to the business. Okay, in the initial stage. Okay, they are also called informal investors, angel funders, provide private investors, seed investors, and business angels. Okay, so these are affluent individuals like who have a lot of money with them, okay, who inject capital for startups in exchange of ownership, equity, or convertible debt. Okay, so this was angel. Okay, then venture capital fund. Then venture capital fund means investment vehicle that manage funds for investors seeking to invest in startup firms and businesses with exceptional growth potential. You might see a lot of VC in. Yeah, you can even Google like the most like the I like the VC like sauce VC sauce.vc. You can Google it, and it is headed by Mano. Like these were the like he's a very good person. Like I admire him. Like I have watched his podcast, and it was very like informative and intellectual. Okay, you can watch them and you will be even interested to like in this field, like what is this VC and all. Okay, the next is characteristics. I have made a short forms. Okay, long term horizon, lack of liquidity in venture capital financing, and high risk is there, and equity participation. Short form is leher. Leher namkeen aata hai na, like there is leher in company use become who makes namkeen. Okay, leher, lehr. L stand for lack of liquidity, then E stands for equity participation, and H stands for long term horizon, and IR stands for high risk. Okay, next is advantages of bringing VC. Lay pen, like take your pen, lay pen. Okay, then L stands for it injects long term equity finance which provides a solid capital base for future growth. Okay, then next is A. E stands for venture capitalists are experienced in the process of preparing a company for an IPO of its shares onto the stock exchanges or overseas stock exchange such as Nasdaq. Okay, Nasdaq, or you can say NSY, like the new NSY, sorry, yeah, Bombay Stock Exchange, NSE, National Stock Exchange. Okay, these are Indian ones. Okay, so P stands for venture capitalist able to provide practical advice and assistance to the company based on past experience with other companies which were in similar situations. Then A stands for capable of providing additional rounds of funding that we will see in the next page. Okay, should it be required to finance growth. The next is N stands for a network of they like venture capitalist also has network of contacts in many areas because there are experienced individuals. Okay, that can add value to the company. Okay, so this was the advantages. Next is the stages of funding. These are not, there is no short form for this. It is very easy to remember. First is like seed money, startup, first stage, then first round, you can say first round, second round, third round, fourth round. Okay, this is very easy to remember. Okay, so I don't think there is a requirement to remember this period, but still we have to know what is there in the every stage because this is the examination question. Okay, so high risk is there, like there is a very high risk in like extreme risk, then very high risk startup stage, and first then as far as we go stages by stages, the risk keeps on lowering. Okay, so in the seed money, what is this? There is an idea plus there is a R&D team. Okay, there is a product development going on, and it involves low level of financing because the person who is investing doesn't know like what is the feasibility, so he might not invest much. Okay, then second is initializing prototypes operations or developing products and marketing. Okay, product development plus marketing at a lower stage. Okay, and next is their commercial production. That production is like you can say larger scale, and like marketing at larger scale. Okay, then there is expanding market, like this is expanding market to a bigger level and growing working capital needs, though profit is not there. Okay, then market expansion much bigger than the like second stage, you can say, because obviously as far as we are going stage by stage, the number of like the expansion is going high. Okay, in the company. Okay, then product development is also there, and acquisition is also possible, and it is also called mezzanine financing. This is called bridge financing. You have to remember these terms. Okay, because these are like keywords. If the I say paper checker sees this word, he will give an answer, give marks to you. Okay, then there is a profit stage in this third stage. Okay, then there is IPO stage, like fourth stage. That is last one. Then we see investment process. I have made a short form like DSP, does this pay, because I couldn't make any other because this is a stepwise process now, so I couldn't like break this short form into like P pehle aa jaye, E baad pehle aa jaye, aisa nahi kar sakte. So first is deal origination. Okay, you can, if you want, you can read, but there is no need to read between the lines. Okay, so yeah, just if you want to read, you can pause the video and just read a little bit. Okay, deal origination, then screening and due diligence, then deal structuring. Okay, then DS. Okay, then P post investment activity, then exit plan. Okay, so you can even read by pausing the video. Okay, because there is no point in explaining it in this way. Okay, just you can remember like second way, like first way is to exit to like selling to third parties. Second way is to exit is that promoter would give a buyback commitment at a pre-agreed rate. Okay, generally between IRR of 18 to 25%. This is like keyword in this point. Okay, next is venture capital funds in India evolution. You can read. Okay, there is not worth of reading. Okay, then next is the structure of VC funding in India. Domestic fund, that is the offshore fund. Domestic domestic is easily understandable, like in India they are registered. Okay, then offshore funds, there are like two type of structure, that is offshore structure and the unified structure. Offshore, in what is this? Offshore is like there Indian advisor, and there is overseas manager who manages the funds, and but there is an Indian advisor who searches the like possibilities of the investing. Okay, then there is a unified structure, like in this they like make a fund, and then you make a trust, like they like let me read, sorry. When domestic investors are expected to participate in the fund, like domestic investor wants to participate in the fund. Okay, a unified structure is used. Okay, overseas investors pool their assets in an offshore vehicle that invests in a locally managed trust where domestic investors directly contribute to the trust. Okay, this is data used to make the local portfolio investments. Okay, so this was like structures. Okay, then Startup India initiative is the like new question that I didn't read earlier, but it came in the mock test. Okay, so I had to read. Okay, then Startup India scheme was initiated by Government of India on like this date is very easy to remember, so please try to remember it. 16 Jan 2016, 16/1/16. As per the Dawn, you need to remember, entity shall be considered as startup if up to a period of 10 years. Up to a period of 10 years, PFL means private company formed LLP. It is like from the date of incorporation or registration. If it is incorporated as a private limited company or registered as partnership firm or an LLP, okay, then it can be called a startup. Okay, effort and next is turnover is less than or equal to 100 crores always. Like it hadn't exceeded this limit at any point of time at any of the financial years in incorporation or registration. Then this is like a theory you can read. Then provided that entity formed by splitting up or reconstruction, you can link it with section 35 AD of the PGBP. Okay, it is similar to that. Like it should not be formed by splitting up or reconstruction and shall not be considered a startup if it is like that. Okay, then this is like a summary of this what we have read in the earlier stage. Okay, this is a like theory question, then you have to read it right now. The startup story of India got a major boost with the launch of Startup India and Startup India programs in year 2016, that is 16 Gen 16. Okay, then it has been creating widespread awareness in general public about startups and gave a boost to the entrepreneurial mindset by setting up a it's not worth reading. Okay, easy financing options such as Mudra scheme, tax benefits such as 100% tax holiday under section ITIC, exemption from angel taxation also provides a much needed push to the young Indian startups. Okay, in Jan 21, the DPIIT this short form we read earlier, okay, Department for Promotion of Industry and Internal Trade, created the Startup India Seed Fund Scheme with an outlay of this. You have to remember, like SISFS with an outlay of 945 crores to provide financial assistance to startups for proof of concept, prototype development, product trials, market entry, and commercialization. It will support an estimated 3,600 entrepreneurs through 300 incubators. Okay, incubators will provide the funding to entrepreneurs. Okay, in next 4 years. Okay, so this is like a 2021, like they are around 2025 you can wait, and this will like there may be some new provisions coming for this. Okay, then a startup recognized by DPIIT incorporated not more than 2 years, okay, at the time of application, and having a business idea to develop a product or service with a market fit, viable commercialization and scope of scaling can apply for SISFS. Okay, a startup can get seed funding as much as 50 lakhs. Like you have to remember this limit also, like this thing, and this thing, and this thing. Okay, the priority sectors you can read. Okay, these are all covered. Okay, then why India became such a sustainable environment for startups? There are the reasons: pool of talent, obviously we know, colleges and B schools every year. Okay, millions of students studying. Okay, then cost effective workforce, then increasing use of internet and technology, then variety of funding options available. Okay, then there is also the easing of FDI norms and opening up of a majority of sectors to 100% automatic route has also opened the floodgates for foreign funding in the Indian startup ecosystem. Okay, so this is like a new topic. Then next added succession planning. Succession planning hoti hai, what is this? This is the process of identifying the critical position within an organization, developing action plans for individuals to assume those positions. Okay, and succession planning identifies future needs of people with the skills and potential to perform leadership roles. Okay, succession planning is an important priority for family-owned businesses such as as most of them are managed by the non-family leader, even though the ownership lies within the family. Okay, it can also provide a liquidity event which enables the transfer of ownership in a going concern to rising employees. Okay, then succession planning is a good way for companies to ensure that businesses are fully prepared to promote and advance all the employees, not just those who are at a management or executive level, so that there is like no bias thing. Okay, so short form is for this, like why there is a need for succession planning. Short form is aligning conflicts with RCT. Aligning means like in family-owned businesses, succession planning helps to align with the culture, vision, direction, and values of the business. Okay, so conflicts means conflict resolution mechanism. This planning is very helpful in promoting open and transparent communication and settlement of conflicts. Okay, so this is like RCT stands for then risk mitigation. If existing leader quits, then searches can take 6-9 months. But if there is like succession planning, so this search will not be like we will not require this search to take place, because obviously the succession planning can easily like counter this thing. Okay, then next is RCT. C stands for cause removal. If the existing leader is culpable of gross negligence or fraud or willful misconduct or material breach while discharging duties and has been barred from undertaking further activities, then arbitral tribunal or any like if the existing leader is removed, then obviously if the succession planning is there, the new leader can be easily be elected. Okay, the next is talent pipeline. It keeps employees motivated and determined, and they can help them obtaining more visibility around career paths expected, and which would help in retaining the knowledge bank created by the company over a period of time and leverage upon the same. Okay, so these were the points of the last two topics. Okay, business succession strategy. First is evaluate the key leadership position. Second is map competencies required for the position. Obviously the lower employees who are capable of filling those positions. Then identifying competencies of workforce, like if there is a capable person available. Then next is bridge leader. In family-owned businesses, appointment of an outsider as bridge leaders will help to develop the business and prepare young family members for leadership role. Okay, next is challenges, like the last topic. Founder mindset might be different than the corporate mindset, obviously very mature for startups to implement the business succession. And last is founders at the face of startups. Like if you assume like of boat, if there is no Aman Gupta, like will you buy the boat product? Okay, I think no, the most of the market of the boat will fail if Aman Gupta exits the boat. Okay, so this was all about this chapter. Okay, so let's see in the next video which chapter we cover. Okay, so bye bye guys, all the best. Like, share, subscribe the video. Okay.